Hi everybody, this is Stefano from the Stoic Investor channel, where we educate and coach people to achieve long-term sustainable investment returns and build their own financial wealth. Picture this, a company has achieved a massive financial success and now is sitting on a pile of cash. So what's the next move? Today, we are going to address a topic that every business dreams of: what to do with the excess of cash. Stick around, as we are going to uncover strategic ways in which companies can maximize their resources to fuel future growth. Many of you are watching our videos without subscribing to the channel. If you think that we are adding some values, please consider subscribing to the Stoic Investor channel, as this can really make a difference for us. When companies find themselves with excess of cash, this represents both opportunities and challenges. In fact, properly allocating these funds is crucial for sustaining growth, enhancing shareholder values, and building a long-term success. There are several options available to companies when managing excess of cash. The first one is investing in research and development, or R&D. In fact, one of the most effective ways to deploy the excess of cash is to invest in research and development. By allocating these funds towards innovation, companies can stay ahead of the competition by developing new products, services, or exploring untapped segment of the market. By investing in research and development, companies can not only propel their growth, but also position themselves ahead of their competitors. You can easily find out if a company is investing in research and development by looking at the income statement here and comparing the actual figure with the previous one from the previous year or the previous quarter. The second option is merger and acquisition, or M&A. M&A activities allow companies to access a new market, acquire new technologies or talent, and diversify their product and services. Strategic acquisition allow companies to immediately acquire new customer, distribution channel, and reach out to new geographical region, therefore boosting their growth. On the contrary, strategic acquisition that do not allow company to access a new market, acquire customers, or diversify their product and services are deemed to destroy business value. The third alternative is to reward shareholders. In fact, a company can decide to deploy the excess of cash by rewarding its shareholders by means of dividends or share buybacks. When a company decides to pay out dividends, it is basically distributing its net income, which provides a return to the shareholder investments, so basically cash in their pockets. On the contrary, if a company decides to buy back shares, it is basically reducing the number of shares outstanding in the market, which is increasing therefore the earning per share, which potentially boosts the stock price, everything else being equal, of course. You can easily check both options by looking at the cash flow statements, respectively here and here. The fourth possibility is to reduce the debt and in general to optimize the capital structure. Companies, in fact, can decide to deploy the excess of cash in order to pay down debt, therefore reducing the interest expenses and increasing their financial flexibility. By paying down debt, company can increase their creditworthiness by also reducing their cost of borrowings, and in general by increasing their ability to mitigate financial risks. Not only that, but also by reducing their debt, companies can free up cash flows that can be used to make a more strategic investment decision and in general to boost their future growth. You can easily find out if a company is paying down debt by looking at the cash flow statement here, and subsequently to the reduction in interest expenses by looking at the income statement here. But how can a company decide between those four options? I mean, is there some sort of hierarchy? Well, one of the basic principles in corporate finance says that companies should invest in projects that yield a return which should be greater than the minimum hurdle rate. By the same token, they should select a funding mix that should allow them to achieve the lowest possible level of hurdle rate while matching the asset side that they are financing. Only when those two options are not available, then and only then a company should consider returning cash to their shareholders. But at this point of the video, you should come with a question: how can we assess whether the company has made good use of the money or not? Well, I would say that the starting point should always be whether the firm has managed to increase the business value or not. In the end, whatever the decision to deploy the cash, what ultimately matters and what should matter for an investor is whether the management has managed to increase the business value or not. In practice, but at very high level, as each topic would require a dedicated lesson at least, this means that if the company decides to reinvest the excess of cash, like for instance in research and development or M&A activities, it has to earn a return which is greater than the minimum hurdle rate. If, on the contrary, the company decides to optimize its capital structure by reducing the level of debt, for instance, it has to be able to strike the balance between benefits and costs. Benefits, like for instance the tax benefit, and cost, like for instance the bankruptcy cost or the cost of having less financial freedom. You can easily check that one by looking at the debt to equity ratio or the quick ratio to understand if the level of debt is sustainable in the medium to long term. And finally, if the company decides to distribute its excess of cash, like for instance by means of buying back shares, you can check at which price the company is buying back a share and compare that with the intrinsic value you have estimated. In this case, you can understand if the company's management is destroying or adding value to shareholders. If finally the company has decided to reward shareholders by distributing dividends, you can check how much was the cash that was indeed available to be distributed by looking at the free cash flow to equity, which is basically the cash available after the debt holders have been paid. In conclusion, companies with excess of cash have several strategic alternatives available to them. However, regardless of whether the company is deciding to reinvest the cash or optimize the capital structure or reward its shareholder, it is key that the use of cash is aligned with the long-term objective, which should be to increase the firm value. If you want me to dig deeper in some of the topics in a dedicated video, please use the comment below. Moreover, if you like the video, please don't forget to give it a thumbs up and subscribe to the channel. That's all for today. Cheers and see you in the next video.